Melbourne apartments the most underrated investment opportunity this year? Now, for years, investors and home buyers alike have actually steered clear of Melbourne apartments, especially in those high-density towers. They've been fearing oversupply, poor quality builds, and, let's be blunt, lacklustre capital growth. But what if this narrative is now outdated? What if the very segment that's been overlooked is now poised for significant turnaround? Well, in today's show, I'm joined by Stuart Wemyss, financial advisor and director of Pro Solution Private Clients, to explore a bold yet data-backed prediction that Stuart's made that Melbourne investment-grade apartments are about to enter a period of strong capital growth. We're going to unpack the economic and demographic and market forces that would suggest this is the case. So if you've ever dismissed Melbourne apartments as second-tier investments, this conversation may just change your mind. And even if you're not interested in buying apartments in Melbourne, the investment principles we're going to talk about will be of interest to anyone looking to buy a home or an investment around Australia. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back again, Stuart.
Great to be back with you, Michael.
Now, Stuart, once a month, for quite a number of years now, you've been on this podcast, and I always recommend your Investopoly podcast. I listen to it every Wednesday in your blogs. I know there's every month lots of new listeners, viewers watching this. So I should explain that why I like your advice and your thoughts and your commentary, and in particular what we're going to be discussing today, because sure, you're a qualified accountant, mortgage broker, financial advisor, and you're the founder of Pro Solution Private Clients. But more importantly, you back a lot of your thoughts with numbers, figures and evidence rather than just what you'd like to happen. So I was really interested in an article you wrote making a strong case for why Melbourne apartments, yes, that everyone's been avoiding, could be one of the best investment opportunities in the coming years. So I'm keen to discuss that today, Stuart.
Yeah, definitely. And, I better put my cards on the table, Michael, because I wrote a quite detailed report in October 2020 expressing the same view. And,
Yes.
I should stand by that and confirm or admit that I was really wrong. I mean, that's 5 years, almost 5 years since that analysis, and they haven't moved, which kind of surprised me, although we couldn't have predicted, I guess, a massive swing in interest rates and COVID, the impact of COVID had. That was probably should have been relatively unpredictable maybe back then.
Well, when you compare the performance of Melbourne apartments compared to apartments in almost every other state in Australia, despite those challenges that you just talked about, Brisbane apartments have gone up close to 50% in the last couple of years. But it was a big claim you made this time again. Melbourne apartments are going to increase significantly in value. What do you think has changed to give you confidence to make this call?
Well, there's a number of things which we'll talk about, over the course of today's episode that have sort of all conspired together that I think is just going to give the weight of numbers to really change demand for that sector. And so I think it would be a demand-led rather than supply-led change, although, supply will have an impact as well. And also, just
lack of supply.
Lack of supply, yeah, correct. And also just the sheer weight of numbers in terms of mean reversion as well. Like if you have a market that's been flat and really the apartment market has been flat since the GFC, so it's a significant amount of time. Each year that it continues to be flat for just means the probability of it entry into a growth cycle next year, for instance, is higher and higher and higher. So it's never going to be flat forever. It's got to change at some point. I thought that change was going to come sooner than it did today. COVID interest rates are probably to blame for that, but there is going to be a lot of pent-up demand, I think, for this sector.
Well, we also should be clear at the beginning that we don't think that all apartments make good investments. There's a lot of things that you and I call investment stock, but that's actually very different to investment grade, which tend to be established family, more friendly apartments. Maybe you could explain the difference and why one performs so much better than the other.
Yeah, so I mean, let's sort of paint a bit of a picture, I guess, in terms of two styles of apartments. The first style are the sort of high rise, high density style apartments, which might be, anything from 30 to 200 in a particular block or tower. And in that situation, there's very little scarcity. If you own a 2-bedroom apartment, it's likely that there's another 40 or 50 2-bedroom apartments with almost the same floor plan as yours. And the most important thing here, Michael, is whilst that apartment block might sit on some very valuable land, your attributable land component of that, your portion of that land, is very, very small. So it's very likely that the land value component of a new build high-rise apartment is going to be less than 10% of its overall value. And we know that buildings, and the cost of building can appreciate over time, but certainly not to the extent as land appreciates. And actually buildings tend to depreciate as well, which offsets that appreciation. So land is really where you're going to get the growth profile from, versus the other type of apartments, which I will call investment grade apartments, are typically built in the 60s or earlier than that, maybe even 70s or earlier than that. They will be located in a suburban location, off a main road on a quiet street, typically on a block of, 4 to 800 square meters, so quite a large block. The apartment, there'll only be 4, 6, 8 in a block. It won't be a huge number of apartments. That block will typically be built in the middle of the block, so there's a lot of vacant land sort of surrounding the actual apartment block. It's either used for a car parking or sort of other amenities. And the building is so old now that it's pretty much depreciated. I mean, it still has some intrinsic value, but all the depreciation sort of happened, and most of the value, so more than 50%, of the value of that apartment is its underlying land value, because it's sitting in a nice quiet street in a great blue chip suburb. And if there's only 4 people or 4 apartments on the block, then each owner has an attributable 25% ownership of that block of land, and that's its underlying land value component. And that's why that it's regarded as investment grade for a whole host of reasons, but because of the strong land value component. And so we're talking about two different assets here.
So you've got a great floor plan. They're solid. They don't leak as much as the new buildings do. Every new building seems to have problems, particularly water problems. And they've got a track record. You can see how they've grown, and we know they haven't grown as much over the last couple of years. But they also have much better floor plans, a lot of them. You don't fall straight into the living room. They've often got entrance halls. Often the bedrooms have got a hallway between them and the living areas rather than being disturbed by noise. So they've got good floor plans. They've got usable balconies, or some even have courtyards. So I, like you, like those sort of apartments. Having said that, though, over the last year or couple of years now, the price gap, the affordability gap between houses and apartments has risen. Apartments in Melbourne haven't gone up much in value. But if people are wondering, well, what are these figures that Stuart and Michael are talking about? You can actually, when in Victoria in particular, but you can get it from other states, you can actually see what the council rates are. So you can see what the council attributes to land value. Not particularly accurate, but it gives you an indication of your land value under your apartment. And the Strata organisation would also be insuring the building for replacement cost, so you could see what it would cost to replace. So very often you can see that if you add the land and the replacement cost, it actually is considerably less than what you're paying at the moment. To buy below intrinsic value limits your downside and I guess increases your upside. Stuart, all the new apartments that are going to come out of the ground, and we know that the Victorian government's encouraging developers to build apartments, as are other states as well, they're going to cost a lot more. Since COVID, building costs have gone up, labour shortages have occurred, material costs have gone up, and anything that involves multi-stories and cranes and scaffolding and particularly unions, boy, that's much more expensive than it used to be.
I was thinking about this very subject, and I can recall it perfectly. I reckon it was probably 10 to 12 years ago, Michael. And, I often think get a lot of topic ideas when I go for a run. I think, well, when I'm running anyway, I was going for a run. I was thinking, like, At that time, you could buy a brand new one-bedroom apartment for about $450,000 in Melbourne, and a existing investment grade one-bedroom apartment probably cost around about the same. And I was just thinking, well, why would you, as an uneducated buyer, why would you ever buy an existing apartment? Of course, you'd buy that new one. It's new, it's shiny, you've got all the marketing material and brochure. Of course, that's attractive. But that's the difference today, Michael, is okay, yeah, that one bedroom apartment, it's increased a little bit, but not very much. When you look at the median apartment price over the last 15 years in Melbourne, has barely kept up with inflation. So it's a little bit more today, but not a lot. But the cost to build a one-bedroom apartment now, and brand new one-bedroom apartment, much, much higher for a variety of different reasons. You've talked about the rising construction costs. So developers are also saying 30 to 40% more to build these high-density style apartments. But also back 10, 15 years ago, a lot of new stock was sold to interstate and particularly overseas buyers, a lot of Chinese buyers.
Yes.
So they were terrible sort of buildings. Now, they didn't have to be constructed that well, sold off the plan. The salespeople would fly over to China, sell a whole bunch of stock, and then no one's really going to inspect it. They'll put some tenants in there, and who cares about it? They can't do that today, with things like, the cracking and the facade issues, all that sort of stuff that we're seeing a lot in apartments in Sydney. That's been well publicised. And if we've got, domestic buyers, particularly owner-occupier buyers, they're going to be more particular about the finishes and the quality of the build. So not only do we have to build better stock, or developers have to build better stock today than 10 years ago, it costs a whole lot more. And so there's going to be that big price gap between what can I sell a brand new one-bedroom apartment for, probably 800-ish thousand, and how much does it how much does it cost me to buy an existing property? There's a significant gap there. And I think that's what will bring pull prices forward of that existing stock.
Well, they're not going to build the new apartments, Stuart, until there's a financial benefit incentive for the developers to do it. And they won't be able to sell those apartments. And they have to sell them, a percentage of them at least, off the plan in advance to get their funding. That won't happen until the cost of established dwellings increases sufficiently to make the gap smaller. So I can see that you're right, that's going to push up the value of established apartments. But I think there's another big factor coming early next year in 2026 that's going to put a fire under the apartments in Melbourne. But let's be fair, not just Melbourne, all around Australia. We know that the government came in with an expanded first home buyers grant where they're going to allow first home buyers under this new scheme to buy with 5% deposit, the government guaranteeing the balance to satisfy the bank's requirement to avoid lenders' mortgage insurance. So in Victoria, that's up to $1 million. So if you have $50,000 deposit, the 5%, and stamp duty, and many people can get the 50, or some can get 50,000 from the bank of mum and dad, or hopefully they've saved it. And sure, they've got to be able to service the loan. That's actually going to now put a fire under the $1 million apartment market. Sure, some people will buy houses, but I can see that lots more buyers are going to push up the value of, push up the price of, there's not a lot of new apartments to buy. They're going to be chasing in the areas they want to live, because a lot of these young first homeowners don't want to live in the outer suburbs where the new homes are. They want to live where the lifestyle and the action is in the suburbs around the CBD, particularly in Melbourne, the inner ring suburbs, but I guess in the other states as well.
Yeah, bang on, Michael. It's exactly the point I was just about to make. And that first home guarantee scheme used to be limited to 35,000 people. So as you said, they're going to open up. It's unlimited. They estimate that there's about between 80 to 120,000 first home buyers in a market in any particular year on average. But with something like this, we'll probably see an increase to that. So that's about sort of 15% of the market, if you like, but it's a much larger share of the sub $1 million market, which is the area that it's going to have an impact on. And we only have to think back to the Rudd government when they doubled the first homeowners grant, just around the GFC kind of timing. We saw that had a huge impact on that apartment market and the demand and the level of sales. Now, some people listening to this might not be old enough to remember back then, but I know you and I do, Michael. So we
Yes.
know that these stimulus, these things can have a significant impact, and 100% it will increase demand, particularly in that sector. And you're right, in terms of supply, I'd looked at the numbers, and I like to look at commencements rather than approvals, because that's the two types of data we can look at
Definitely.
that look at housing supply. So commencements are really the stuff that is going to be built, even though it takes about 18 months for that stock to come online. Well, when you look at the sort of average level of apartment or attached dwelling construction, so that could be apartments, townhouses, or units, but it's probably mostly going to be apartments. It's about $2.2 billion per quarter on average, where in today's dollars, back in 2009, it was about $3 billion. So it's about 30% less in terms of value, but we've just spoken about value is not a great measure. Unfortunately, they don't publish the number of dwellings, like the units, so more than 30% below. Whereas you look at Melbourne's population over that period of time, since 2009, it's up about 7.5%. So we've got 30% fewer apartments, but 7.5% more population. It's definitely showing us that there's a supply shortage in that sector of the market.
Now, I quoted the figure of $1 million, the cap for the first home buyer grant in Victoria. It's actually $1.5 million in Sydney or New South Wales in general, because regional parts of the country also have the same cap as the capital cities. So that is going to boost property values all around Australia. But Melbourne is in very much better position, I agree with you, to get the benefit from that, because the cost of Melbourne apartments is so much lower than all around Australia.
Yeah, that's right. We tend to have, I think, more apartments in Melbourne than there is in other parts of the country. But as you said at the beginning, Michael, the Brisbane apartment market's already kicked off. It's up about 60% over the last couple of years already. So relative to houses, still looks pretty good value, but not as good a value as it did 2 years ago. And Sydney apartments tend to have performed more consistently, just really around density limits and the geography of Sydney. I think that has certainly helped that sort of sector of the market. But as I said, apartments in Melbourne have only performed at inflation for the last 15 years. So when you look at the relative value to other parts of Australia, and then the relative value to houses, the median apartment price is, so the median house price is about 1.5 times the median apartment price. Only a few years ago, it was 1.6, and it's only just because houses have come back a little bit that it's fallen to 1.5. But the average is 1.3. So even relative to houses, I would say houses in Melbourne look like good value too, but apartments even look like better value than houses. And I think you put all those factors together. If I was a buyer in this market, and I had a budget of sub $1 million, that's where I'd be putting my dollars, into an investment grade apartment in Melbourne.
More than that, I'd be doing it before the 1st of January 2026, when there's going to be a lot more buyers in the market at a time when interest rates are probably going to have already dropped at least once, more likely to twice more too. So they're going to be able to afford more as well. So there is a window of opportunity. And again, Melbourne's population is, I'm sure you've read the same as me, the government has updated its forecast and going to get to 9 million people by 2050. So I'd be getting in before those other 4.5 million people do, Stuart.
9 million people. I scratched my head when I saw that. Where are these people going to live? That's right. Look, that sector of the market tends to be very sensitive to interest rates, Michael, because, a buyer that has a relatively limited budget, a budget of less than $1 million isn't limited, of course, but relative to, property markets tend to be a lot more sensitive with interest rate changes. You'd only need interest rates or borrowing capacity to move a little bit to really push someone into another sector as well. So, if I've got a budget of 650, if I can increase that budget to 750, I've now opened to a almost completely different sector of the market or quality of asset. So they tend to be very sensitive. Also, the changes around the HELP or HEX debt, Michael, will help first home buyers. So That's where obviously someone's got a university debt. Normally lenders will take that into account in terms of the repayments. And depending on their income, that could account for 10% of their taxable income. So, it can really destroy savings or borrowing capacity, I should say. Now, the government's given lenders a little bit more flexibility. If that debt is to be repaid over the next year or so, they can ignore it. But also with this government guarantee, a first-home buyer might actually be better off using their savings to repay their HECS debt, since they don't need as much money now as a deposit to avoid mortgage insurance to buy into the asset. And that'll do two things. That'll still won't prevent their ability to get into the property market, but it will massively increase their borrowing capacity. Because with borrowing capacity is driven by two things, Michael, as you well know, the security. So that's how much deposit do I have? Well, the government sort of tick that box with their guarantee. And then serviceability, which is how much can I afford to repay? So if we get rid of the HECS debt, or at least get it to a level where it's going to be repaid within the next 12 months, the lender can ignore it. That'll increase their borrowing capacity. And so these changes in approach will, as I said, a sector of the market that's already sensitive to these matters will further enhance their ability to borrow. And we know that there's a very, very direct relationship between money supply and property growth. So if we see loan volumes increase, we know that always translates to property growth.
Now, I know that you've produced a lot of charts over the time, and we've published them in Property Update, where you've shown that over the long term, the Melbourne property market over the last 40 years has outperformed. But you've got these lovely bar charts where you show in every state there's been periods when there's been strong performance, middle performance, and then every state, every capital city has had periods where the property markets have virtually not performed for 3, 4, 5 years. Look at Perth, it was longer than that. Look at the last couple of years in Melbourne as well. And then they revert to the mean. This is not a fine for owning properties in Melbourne. It's a fee for being an entrant in the biggest, one of the biggest property markets in Australia. This is just the cycle behaving as it always does, not maybe like you and I wanted it to, but this is nothing new. And so therefore that should give comfort to people to know this has happened in the past. Be comfortable with the fundamentals, because the fundamentals for Melbourne are strong population growth, strong employment, not enough supply for all the people coming in. And it's still one of the best cities in Australia to live in and one of the best countries in the world, Stuart.
Yeah, and Brisbane market is a perfect case in point for that,
Isn't it?
Michael. The Brisbane market was subject to a huge influx of supply. In fact, about sort of 10 or 15 years ago, in fact, a lot of those, and there was a lot of talk in Brisbane, the only people that are buying these apartments are people that don't live here. So a lot of apartment stock was sold to not only overseas buyers, but people in Melbourne and Sydney. And I know that there was a few groups marketing that. I've seen the outcomes of that in terms of people buying apartments 15 years ago for 600,000, and then 2 years later they're worth 450 or something like that. But anyway, it was a supply issue. There was a massive influx of apartments. So between mid 2008 and March 2021, the Brisbane median apartment price didn't do anything. It went sideways. So a flat cycle there for 13 years. But since early 21, we've seen a 60% rise in apartment markets. It was always going to happen. We could see the oversupply of apartments. We knew that we were going to go through a flat cycle. What we didn't know is, will it happen in March 21 or March 22 or March? Who knows? We don't know the answer to that, but we know it will happen. And you're right. I've observed, and both in houses and apartments, there's two distinct cycles: flat cycle and growth cycle. The average growth cycle, average and mean growth cycle, bang on 10 years. If you go back to 1980 to today, and the average flat cycle is 7 to 8 years, Michael. So certainly you'd say Melbourne's been a flat cycle for 15 years. So it's double the time. I mean, Brisbane was 13 years. So I don't know how long it could last. It can still last another couple of years potentially, but I just think these changes in terms of interest rates, borrowing capacity, the stimulus from the government guarantee, further tightening in supply of new stock, all these things are going to conspire, I think, to create almost a perfect conditions for this sector of the market.
Well, we're seeing that in the market already. Melbourne auction clearance rates have been high weekend after weekend. There's an increased depth of buyers with a small amount of properties for sale. Buyer sentiment always improves before seller sentiment. When they see auction clearance rates rising, property values rising, properties being sold, they start to put their houses on the market. That doesn't just mean there's lots more supply, because most buyers are sellers as well. So I agree with you that the Melbourne apartments are likely to be the most underrated investment opportunity over the next year or two. But there's opportunities all around Australia, so you can't just jump in buy any property in Melbourne, as we said. In fact, as we've already said, there's investment grade properties, and avoid what we call investment stock, which are the developer stock. Stuart, thank you once again. I think people who've been listening to us, watching us, can hear the depth of information and perspective you bring, and you bring that to your clients for Pro Solution Private Clients. Can you tell us just a little bit about how you help your clients?
Most decisions, Michael, are multifaceted. They take into account tax considerations, cash flow, has an impact on retirement planning and investment strategy, borrowing capacity, these sorts of things. So we've built a team that provides holistic advice, which means our accountant, our financial planner, and our mortgage broker sit around a table, talk about our client's situation, and make sure we find the best answer for them that optimizes all those considerations.
Fantastic. Well, I look forward to catching up with you again next month. And over the months, we'll keep talking. It'll be interesting to see whether your bold prediction comes true this time. By the way, it will. It's just the timing that we're not certain about.
I'm happy to be held to account. No problem.
Thank you very much, Stuart.
Thanks, Michael. Cheers.
Before I share my popular mindset message with you, I want to point out something you probably already know anyway, that the property market's already turning. The government is now fueling the flames of our housing market with their housing policies, with the Big Australia policy, at a time when we've got a chronic undersupply of homes. And that sets the stage for the next leg of our property cycle. And with multiple interest rates likely over the next 12 months, we're entering what I see as a rare window where today's decisions could mean your financial security tomorrow, or it could mean a missed opportunity. Look, by the time all the headlines start talking about a property boom, it's too late to get in, or it's too late to get in early. And at Metropole, we've seen this before. Buyers hesitate, then confidence returns, then FOMO kicks in, and all of a sudden prices start to surge. So my recommendation to you is don't wait for the crowd. In fact, get in ahead of the wave. So I'd like you to take the opportunity of having a complimentary wealth discovery consultation with one of our wealth strategists at Metropole. Together, we're going to clarify your financial position and what you want to achieve. We're going to talk about what makes sense of where the market is at the moment, where it's heading, and of course, answer your questions about that. We'll also help explain how you could position yourself to take advantage of the opportunities that some are going to miss until it's a little bit too late. We're going to explain how we can develop a strategic plan tailored specifically for you. Look, the markets move in cycles, but wealth is built by those who act during the turning points, and that's what we're experiencing at the moment. So don't be the investor who looks back in 12 months' time and says, I should have. So go to metropole.com.au and book your free wealth discovery chat today. It's your chance to make confident, informed investment decisions before the rest of the market catches on. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I want to talk with you in my mindset message about what's sometimes called the IKEA effect, why you need to do the hard things. We're always told do the hard things, but there's a deeper reason behind it. We don't value what comes easy. We value what we earn. Think about it. The investment property you've saved for and researched meticulously for, the business you've built from scratch, the relationships that took work to evolve, the body, the mindset, the peace, all of that forged through effort. It turns out there's actually a name for this. It's called the IKEA effect. Way back in 2011, a study showed, the behavioral scientists did a study, and they discovered we assign more value to the things we build ourselves, even if it's imperfect. And if you've seen me work on IKEA, you know what I'm talking about. So if ever you've wondered why IKEA furniture feels so satisfying despite the sweat and the swearing, or adding an egg to a cake mix suddenly made it easier and made it taste better, I guess the act of doing the work makes the outcome matter more. And this doesn't apply just to cakes or coffee tables. It applies to your career, your investments, your health, your relationships, and your personal growth. Struggle adds texture to life. Effort creates meaning. So next time you're tempted to take a shortcut or quit when it gets tough, remember, the difficulty is the point. It's the cost of entry to something truly worthwhile. So my message in my mindset message for you today is do the hard things, not because it's easy, but because it's worth it. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour. And you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?